Hi, this is Brian Perry. I'm once again here with Aaron Swenson from PRMI Mortgage. Aaron is a fantastic local lender based out of Delray Beach, Florida. Aaron, I wanted to ask you about another topic that you've been telling me about, and I guess we just closed a client with recently, which is a non-QM loan.
Yeah.
Is that what it's called?
Yep, non-QM.
Can you explain to me what that is?
So non-QM is basically like a non-qualified mortgage. So there's categories if you think about with financing. You have FHA, VA, conventional. Those are the standards.
Standard
right?
financing, yeah.
If you can't qualify in those buckets, the number one problem I always run into is people that are self-employed. So self-employed people, most people will typically write off everything, right? I mean, why would you want to give the IRS any more money than you have to?
Yeah, they take a lot of deductions or whatever,
Yep.
and they show low income. They do that intentionally.
Correct.
Right. Mm-hmm.
And I mean, rightfully so. That's why you run a business, is that you can deduct everything.
Right.
So these non-QM products give people that are self-employed the opportunity to be able to purchase without having to use your tax returns. It's huge. So the first programs, there's three different ones I want to just quickly cover. One of them is a 12-month bank statement program. This is awesome. So like if you have personal or business bank statements, you can add up all of your deposits. The bank will add up all your deposits, divide by 12, and that's what your income is on business or personal.
Just deposits.
Just deposits.
Not net profit.
Nope.
Not net nothing.
Just deposits.
Just deposits made into the bank. That's what they're judging the income on.
Correct.
Wow.
Now, here's the caveat: is they will typically use 50% of what your deposits are. Okay, so if you're running a good business, you usually probably have 400,000, 300,000, whatever it is. So they'll let you use 50% of that. Here's the caveat: is if your CPA, if your expense ratio is less than 10% or whatever it is, your expense ratio,
Right,
okay,
right.
you can get a CPA letter that says Brian Perry's business is less than 10% expense ratio, and then they'll take 90% of your deposits.
Wow.
It's huge.
But without that, it's just a flat
It's
50%.
50, correct.
Right.
But like,
which is usually, I mean, you guys usually use a 50%, what do you call it? Debt to income. Exactly. So that kind of like, it's kind of that same concept.
it's just, it's for most the non-QM lenders is just standard of them using 50%. But what you would want to do is, like, if your CPA can say, hey, okay, even if you have a 30% ratio, like have them write, he only has a 30% expense ratio because then you can use 70% of your deposits.
That's great.
So the thing is, if you have any relative
Do you have to
income,
provide like a P&L
Nope.
or anything like that?
just bank statements.
Just bank statements. That's incredible.
But it needs to come from a certified public accountant. Like they need to be registered. Like you can't have your brother or sister fill out your CPA letter. So you need actually a real public accountant that does it. But like I've never had anybody not qualify for that runs a sufficient business that can provide by bank statements.
Yeah, that's great.
Here's the thing: is they're very aggressive on their program too. I had lenders that were willing to go up to 90% on an owner occupied, and the thing I'll tell you is the higher the LTV, the worse the interest rate is. So if you go
Loan to value.
correct,
Right.
So but usually you want to be like 85, 80, 75.
So around 20% down.
I would recommend 20, but like you can do 15. The beautiful thing with 15% is they don't charge you private mortgage insurance.
Wow, really?
There's no PMI with 15% down going
that's
12 months
great.
bank statement. So
Because in conventional loans, it's anything under 20 is PMI,
you're
right?
paying PMI, but this program doesn't require it.
Wow.
So that's the first program. You have any questions on that one?
No, and so just to recap real briefly,
Yep.
self-employed people, they only use deposit history, and then they'll just use a percentage of that, either 50% or whatever
CPA
the
expense
CPA
letter.
expense
Yep.
letter says. Got it.
Yep.
That's awesome.
It's an awesome program.
Yeah. So, and just to contrast that, normally you'd have, if you're self-employed, you have to provide tons of documentation.
horrible.
You have to do a P&L. It's an incredibly arduous experience. I know because I'm self-employed,
Yeah,
right?
yeah,
You've done it
yeah.
for me. And so this is just such a simple, clean way to do that.
Yeah,
right?
I mean, to be honest, I've never seen tax returns that people show money on.
Self-employed people.
Yeah,
Because
I mean-
self-employed people, they do pay a lot of expenses. They're able to take a lot of write-offs. But they know that if they're planning on buying a home, that they just, even though they're legitimate write-offs, they take fewer to show more income, right?
Yeah, and it makes sense because, like, why do you want to pay the IRS more than you have to? I mean, that's
Sure,
the
of
luxury
course.
you get of being self-employed. But that's
We're
why,
not assuming that they're doing it illegally. We're assuming that they're taking appropriate write-offs.
Right.
But yet they have a choice to not take the write-off. It's not illegal not to take a write-off and just absorb that as income.
Yeah.
And now you could say, okay, Aaron, well, I made $250,000 last year rather than $50,000, right? So that's what we're talking about. And how are the rates on these, Aaron? I know you mentioned it.
They're aggressive.
They're good
I was
rates.
just telling Julie that actually the interest rates on some of these programs, even on the 12-month bank statements, is better than conventional today.
That's amazing.
Better than conventional today. So people are like, oh, I'm sure they're going to charge you 5 points on these loans, and they're going to charge you, 10% interest rate. You're not lending money from Guido, okay? So
right. These are legit
this
loans.
is like they will give you a super aggressive interest rate, and it's fantastic.
Is this
program.
is this a program that you have access to specifically, or is this some kind of federal program?
Oh no, it's so like there's different banks out there that realize that conventional has their sticklers for their programs. They're like, these are our guidelines, and this is what we do. And banks came out with, how do we think outside the box and we can lend our own money? So here's the thing is, they set up their own guidelines. There's no rules or regulations to them because they're like, these are our guidelines, these are our interest rates.
Right.
If you don't like it, then go somewhere else.
Yeah, because it's not a Fannie Mae.
No, it's not a Fannie Mae, and it doesn't even go through DU. Like when you run underwriting, it does not get approval. Like all you have to do is make sure their debt to income.
Because that's all the Fannie Mae guidelines.
Correct.
So it's easier to qualify for. It's simple. The interest rates are very aggressive. There's no additional fees to it. So if you're self-employed, you really need to connect with us with Aaron on this because it's a big deal.
The prior program's fire. Like, I mean,
If you're self-employed and you've ever gotten a conventional loan of any kind, you know the arduous uphill battle that is.
Yeah.
This is huge.
They want everything except a blood sample when you get into those
It's a big
programs.
deal. Yeah, and you're being kind with the blood sample. Yeah. All right, thanks, Aaron. That's an awesome program.
Yeah, it's great.
Non-QM.
So but in addition to the non-QM, there's another program called a P&L through the non-QM. So let's say you have the bank statements and you're just like, oh, you know what? I don't have enough deposits. You can have a CPA fill out a P&L for the year, okay? And what they're going to look at is minus all your expenses and everything when it's all said and done, what your bottom line number is, okay? So
net after expenses.
here's what's so crazy. It's mind-blowing because I've been in the market for 26 years and I just can't believe they've gotten to this point. But when they go and subtract all your expenses, what's so amazing is they look at the bottom line number and they won't even double check of what your CPA put down of what your expenses are.
In other words, they don't go through and scrutinize the P&L. They don't
care.
check expenses. They just want to know that a CPA put this together.
That's it.
And then what the net bottom line is. Got it.
So like if you had a CPA put that you made $160,000, guess what? No questions asked. They'll let you use $160,000
if you netted
a year.
160, right.
And they'll divide by 2, and that's what or divide by 12, and that's what your income is.
Right. So it's similar to the QM, but in this case, it's a P&L.
P&L, correct.
It has to be prepared by a CPA.
It has to be prepared and signed, and they have to be registered. So that's very important that they're registered.
They have to be an official licensed or CPA or whatever that is, right? Yep.
So that's the second one, okay? And the third one is this is a great program for people that want to buy investment properties. This is called a non-QM DSCR loan. And you're familiar with those?
I'm familiar with DSCR. I've never heard of the non-QM component there, though.
It's amazing because they allow.
So let's take 2 seconds to describe a DSCR loan so people understand that.
Yep. So DSCR is basically you've always wanted to buy your first investment property. Maybe you own multiple. What it is they allow you to purchase a investment property with no income and no employment.
They're basing it off the income that the property itself generates.
Correct. So there's a ratio, what they call is a 1-0 ratio on these DSCRs, okay? And the 1-0 ratio means that let's say your mortgage is $3,000 a month.
Right.
He's going to fill out a 1007 rental schedule, okay? What the average rents are in that area, and it needs to exceed $1 more than what your mortgage is.
Got it.
So it needs to be $3,001, and guess what? Then you qualify for the loan. Now, I will tell you if that doesn't add up and it doesn't work out, you can still do it. You probably would just need to put down an extra 5%.
Got it.
Okay? Because then they lower
What percentage down does it normally require?
Well, you can do 15%, no private mortgage insurance on that.
Got it. Yeah. So similar
Same
idea
thing.
to the non-QM.
No income, no employment. So here's the caveat. I just worked up one of these. 15%, no private mortgage insurance, no income, no employment. The interest rate, it's going to be higher because it's a high risk investment property loan, right? That was
because they don't require income. They have no income requirements of the borrower
or job
whatsoever. So you can imagine lending somebody with no income and no job, $500,000 to buy an investment property. That's a risky proposition, right?
I mean, no offense, I wouldn't lend it to you. You know, like,
well, that's harsh, Aaron. That's harsh. That hurts.
I'm just saying, like, I mean, to give people no income, no employment on 15% down, like you're just throwing people in the lion's den.
But to be fair, these are investment properties, and they're essentially verifying that the income will pay the mortgage. So it allows you to buy a property even if you have no income. It allows you to buy the property based on the income the property is generating, right?
Yeah, but
does it have to be existing income? Does it have to be fully rented? No. This is just potential income that you're going to get.
It's going to be whatever the appraiser puts on the rental schedule. So, like, if it on the rental in the community is somewhere around, whatever it is. So, like, you typically, if you're doing a DSCR, you don't go and buy a $600,000 house because you know that you're going to need to find rents that are going to be somewhere around $5,000.
These are usually multi-unit.
Yeah, properties. Like if you do
2, 3, maybe
even
4
single
units.
Family. I have one guy that I've done a ton of business with. He's bought 6 of them under this program, right?
So, but it's anything residential, which is 1 to 4 units.
Anything
even above
even
4
condos.
Units.
Anything you want.
Does it go above 4 units though?
They can. I think they can actually even go up to 6.
Because that'd be commercial. Up to 6.
They can. I think they can go up to 6. I haven't. You don't see a lot of 6 units in Florida, but like
no. But the bottom line is though the potential rental income has, or the appraiser's rental schedule has to exceed the mortgage payment by at least $1.
That's only if you put down at a high risk and putting down 15%. So here's the thing I want to tell you is that the one I just worked up, like 15% down, the interest rate was 8.2. Okay, it's a little bit higher, but listen to this: you put down 20%, it goes down to 7.3, almost a full point. You put down 25%, this is crazy. It goes down to 6.5.
That's pretty well in line.
Lower than a conventional owner-occupied residence today.
Right.
So they're basically going to give you conventional interest rates with no income, no employment.
Which is pretty cool, too, because even when you're borrowing conventionally to buy an investment property, you usually have to put 25% down anyway. So they're giving you market rate at the standard investment down payment, and they're also giving you options to go lower down payment, higher rate, but that's up to you, right? If that's your situation. So that's pretty cool.
The one thing that's really important to know is if you ever want to buy an investment property, this is the way to do it, okay? I'm telling you right now, since the crash of 2008 and 2009, Fannie Mae and Freddie Mac wants nothing to do with investment properties. When I go in there and price the loans, people are like, oh, maybe I can go conventional. When I price it up, they're worse than doing a DSCR loan.
No kidding.
Every single time. Like Fannie does, like, they do not want that on their books. Because remember,
and you can't, with a Fannie Mae loan, you can't go a penny below 25% down payment on an investment.
No.
So they're super restrictive with investment properties through traditional Fannie Mae financing, right?
And most banks just don't have enough people to buy them. So you got to remember, Fannie and Freddie, their job is to say, okay, this loan can be funded.
They can't resell it on the secondary market.
That's it.
Right.
Yep.
Right.
And these banks will sometimes service them, sometimes they'll sell them, but this is the hottest thing on the market. If you want to buy an investment property, this is the way you do it.
That's a great one. Yeah.
Yep.
Thanks, Aaron. Anything else? Did we cover it all?
No, I think that's everything.
By the way, anybody watching this, you just learned more than most mortgage people and most realtors know about these programs.
I know everything about every program. So
if you have questions, call him. Call Aaron. He's great. Yep. Thanks a lot, Aaron.
No problem.
Appreciate
Thank
it.
you, Brian.
Bye.